Welcome to Poor Millionaires. Today we're joined once again by Clive Thompson. Clive is an ex-Swiss banker who's recently become a bit of a YouTube sensation by sharing his investment insights and experiences, particularly when it comes to investing in gold. In this episode, we'll be delving into the possibility for a revaluation of the US gold reserves and the implications that could have for the markets. Poor Millionaires is a show for people with investable wealth of $1 to $20 million. We strive to educate, connect, and inspire, to give you the tools you need to thrive and secure lasting prosperity for yourself and for your family. PoorMillionaires.com. Invest with ambition. This podcast is for educational purposes only. The information does not constitute financial advice or recommendation and should not be considered as such. Value of investments and any income derived from them can fall as well as rise, and you may not get back the original amount you invested. Clive Thompson, welcome back to the Poor Millionaires podcast.
James, thank you very much for having me on again.
It's great to have you back. Last time you were on the show, we touched on the topic of a potential for the revaluation of the US gold reserves, and that's what we're going to be digging into a little bit deeper in the show. But before we kick off, we've got to touch on the fact that gold has gone through $4,000 an ounce for the first time in history. So just give us a bit of context about that move and what its significance is.
Well, first of all, I'm going to tell you, I don't think it's unbelievable. I think it's absolutely expected. It's just that not many of the banks and forecasters use the 4,000 number in their forecasts. In fact, a day or two ago, just as gold was going at 3,977 on the way towards 4,000, I saw a very major bank, a well-known bank. I won't name them because I don't want to embarrass them, but you can find it. It's an extremely well-known bank who came out at the price of 3,977 and said, "We think gold will touch 4,000." And I thought, you know what? What all you're doing here is trying to score another point on your tick sheet when you go to your bosses and say, "We've got 25 predictions right," because we predicted 4,000 gold. But I also, I think that most banks and investment managers aren't yet sufficiently into gold. And the reason I say that is I attended an investment conference a couple of weeks ago. And of course, gold was soaring at the time, as it has been for all this year. I guess at the time it was like 3,700-ish. And one of the biggest investment banks of the world, we had the chief investment officer speaking, and I happen to have a discretionary portfolio with them, so I know this bank very well. Anyway, this CIO was speaking, and he said something along the lines of, when he was talking about all the investments they made and how they'd ridden the technology wave and how they into gold and all their clients be profiting with gold or something. And it was along the lines of gold's a good thing to have in the portfolio, and that they'd recommended it. So I thought, I'll have a look at my portfolio. And this is discretionary, and it's growth, and there wasn't any gold in the portfolio at all yet. So, I think what's going on is that they're saying to their customers, yes, gold is good. We've got it. We're putting in the portfolio, but it takes time sometimes to implement these changes. They probably they have the recommendation. They say, okay, all clients have got to have 2% gold or whatever the number happens to be. It gets fed down to the investment managers who say, okay, well, let's get started. Well, which portfolio? Let's start with this one first, then we'll do that one, then we'll do that one. And it takes time to implement it. So you could be 3 months behind the curve with your investment manager, assuming he's already said we should have gold, because he might not get to you first. So what I think we've got is a situation where there will be, and there's bound to be, many more investment portfolios which start to have some exposure to gold before we get to the end of the year. And that's called window dressing. And I know it. I mean, I'm possibly guilty of it myself. I worked in investments for nearly 50 years. And you don't want to get to the end of a year, send out your portfolio valuation to the client, and then the client rings you up and says, "My friend had some exposure to," and then he names some sector or some stock that you weren't exposed to. So there's a natural tendency when you see what the winners are to chuck some money into the winners, thinking, well, if they carry on winning, at least I've got it, and if they don't, I can always get rid of it. So that's called window dressing. In other words, you want to make, in the last quarter of the year, you want to make sure that your portfolio contains some of the winners of the first 3 quarters, and you're hoping that they'll continue to be winners in the last quarter, so that you can say to your clients, "Oh no, I rode that wave. Don't worry, we're really good. We're really smart." And the reality is, vast majority of clients uh, can't really tell if they should have made 60% or 20%. Obviously, you probably if you go in the last quarter, you probably only make 10 or 20%. If you got in the first quarter, you might have made 40 or 50%. But the client isn't going to know that. They're not down to that level. It's the investment managers, you and I, those who follow the gold price or a particular stock price. We know what could have been done, but at the end of the day, clients are really just thinking, I hope my investment manager's got some gold, and those calls will be coming in now. So investment manager will be getting the calls, and so they better be in gold
Yeah.
before the call comes.
I can tell you that the calls are coming. So I was in a lunch the other day with a bunch of fund managers and investors, and some of the fund managers were commenting that they've had calls from clients saying I need some gold in my portfolio. Where do I begin? And most people kind of it seems to be a sector that most people are completely unfamiliar with. And obviously, the sort of allocation to gold in global portfolios is minuscule, isn't it? When you look at it against, tech, for instance. I mean, it's less than 1%, isn't it? The global
Yeah.
allocation to gold.
So I've seen that number. I haven't found a way of checking it myself. I haven't tried to test it, but I've seen that number less than 1% in global
Yeah,
portfolios is in gold. But I think we've got to just question that a little bit, because perhaps a lot of these portfolios don't have the mandate to invest in gold. So, for
absolutely.
example, if you have an S&P 500 fund, an ETF, or a fund which tracks the S&P 500, you wouldn't be able to put gold in such a portfolio because it's not part of the mandate. If you have a
Mm.
technology fund, you wouldn't be able to put gold in it. So I think the reality is probably the actual exposure to gold in the portfolios which are allowed to have gold is probably less than 2%, but it's still going to be very low.
Mm.
And I think that number could creep up gradually. I don't think it'll creep up very fast, because whilst I listened to this investment conference, and we had various chief investment officers speaking, uh, there weren't that many who even used the word gold. There were even less who used Bitcoin, funnily enough. but when I say they used Bitcoin, it wasn't like you're going to buy Bitcoin or anything. It was more a tacit acceptance that it might be an asset class, and
Yeah.
there weren't many of those. There were a few more who were talking about gold, but most of them still continue to talk about the how wonderful technology is going to be, how artificial intelligence is going to change all our lives, and how it's the number one place where you've got to have some money, because if you're not in the artificial intelligence, you're not going to be riding the wave of
Yeah.
where the future growth is going to come from.
And
So
doesn't this
that's
point to a bit of a shortcoming when it comes to the whole financial services industry? Because when you talk about things like, I mean, if we talk about physical gold, for instance, there's no incentive for a financial advisor to sort of put their client in physical gold, because they're not going to earn the fees from a product like that. So why would they advise their client to buy physical gold, for instance? It's,
Well, they would. They would do it via an ETF. But if you're a private individual, I think every individual on the planet needs to own some gold.
mm,
And the reason they need to own gold is because physical gold. I don't mean gold in an exchange traded fund. Of course, you can have that too.
yeah,
That's another way of thinking, and nothing wrong with that. But whether you have the exchange traded fund, whether you have gold held by your bank, you still need something which is, to all intents and purposes, in your custody. Whether you've got it locked up in a safety deposit box where you've got the keys, or in the bank, or buried in your garden, or hidden under your pillow, well, it doesn't matter. But I think everybody needs to have some physical gold which they can lay their hands on, because it's the one asset which has withstood the test of time, been through
yeah.
wars, revolutions, kingdoms, empires, and yet those who had it could still get to the other side of whatever was going on with some value. Whereas those who had the paper money, or the money held by some custodian, often found that they got to the other side, and what they thought they had is no longer going to buy anything.
Absolutely. It's the only asset with no counterparty risk, right?
Exactly. You're not relying on the promise of somebody else. It can't. It's not like an institution who could suddenly go belly up and default on you. It can't default. If you've got it physically, it won't default. And no, you don't need somebody's permission to do what you want with it.
So let's delve into this whole gold revaluation issue then, because this is something that's been doing the rounds quite a bit recently, I think. And you yourself have talked about the potential for the US Treasury doing a bit of sleight of hand and sort of revaluing the gold reserves. But I think effectively what this really means is kind of like a devaluation of the dollar, isn't it? Essentially. So just give us your thesis on what you think might happen in this regard, and
Well,
also what are the assumptions behind your calculation, because you specifically said $15,000 an ounce, didn't you? So just tell us what the assumptions are behind that as well.
sure. So first of all, I think a revaluation of gold is fairly likely, very likely actually, because I don't think the USA can afford not to do it. The debt is rising in the United States by something like $2 trillion a year, and it's reaching unsustainable proportions. Well, I think it reached unsustainable proportions some time ago, so we're now already past the point of no return, and that debt is going to continue to spiral higher and higher, not only because the government spends a lot more than it takes in taxes, and there's not a lot of enthusiasm to raise the taxes or to reduce the spending because you'd have riots on the street if you did the latter. So, but the other problem is the amount of interest which has to be paid on this national debt. It continues to rise, and it will continue rising. And that's not me forecasting it; it's the Bureau of Labour Statistics, the official government agency which does the future budgets. They see that continue to rise. Now, the level of interest has gone in a few years from about 8% of the tax take to 18% of the tax take, in about 3 years to go from 8 to 18. And it's going to go higher next year and the year after, and probably for the years in the future, assuming that interest rates stay where they are and don't go to zero. Of course, if interest rates go to zero, that tax take could go the other way. But we're really I think we're into a situation where the debt is starting to spiral out of control. I don't think there's anything which can be done anymore to get that debt down, except for the gold revaluation, which I'm going to talk about and explain how that could work and why I get to a figure of 15,000. Now, when I came up with my figure of 15,000, it was below the consensus at the time, which was around 20,000, and I got a lot of messages from people saying, why not 160,000, which would be enough to pay off the entire national debt of the United States? And I also got a lot of messages saying, don't be daft, they're not going to do it. If they do it at all, they'll do it at the current gold price level, because it wouldn't make any sense to do it at a level higher than that, because everyone would then sell their gold to the Treasury. Well, I got my answers to all of those. They're all valid comments. So let's start with what is a gold revaluation and how does it help the US government? So the US government holds around $11 billion of gold at the official price of $42.22 an ounce. That's 11 billion. If it was revalued to today's price, it would be roughly 1 trillion. Now, that on its changing the price on its own won't do anything. What they've got to do is find a way of keeping their gold and getting that extra $1 trillion in cash so they can spend it or pay off their or reduce their debt. So we're talking about if they do it at the current gold price of $4,000. So how would they go about magicking $1 trillion of gold into $1 trillion of cash and $1 trillion of gold? Seems like magic, but luckily for the US government, there is a magic trick that they can use. And it's a nice, easy magic trick. And it was actually spelled out in what was called the Bitcoin bill. Was that Judy Shelton's bill, which hasn't become law, by the way, but basically the mechanism for doing it was spelled out in words of one syllable in that bill, and that bill. Well, it was called the Bitcoin Act, actually. It might come back, and they might still do it. So, although the Bitcoin Act was about the Bitcoin, to fund the Bitcoin purchases, they proposed just what I'm going to talk about now. So the way
they wanted it to be budget neutral, didn't they? I think that was the
So the way this is going to work, if and when they do it, as I said, I don't think they've got any choice but to do it. And I'll use the current price of $4,000 before I get to the $15,000, which I think is the level where they should do it, and explain how that works. So the gold today is worth $1 trillion, and sitting in the Federal Reserve, which is a different agency, it's not an agency of the government, it's an independent agency, is the $11 billion of what's called gold certificates. So the Federal Reserve has got gold certificates, the government has got the gold. The gold belongs to the government, and those gold certificates held by the Federal Reserve, worth exactly the same amount. How do they get the gold certificates? Back in 1934, the government passed a law whereby the Federal Reserve was forced to sell all its gold to the Treasury in exchange for gold certificates. So they now have these gold certificates, but these gold certificates are not redeemable. They're not redeemable in anything, certainly not in gold. They are redeemable in cash if the Treasury so agrees, but only at the official price of gold, $42.22. They can't get the gold anyway. That's by the by. So the proposal would be that the Federal Reserve redeems their $11 billion of gold certificates for cash, which is paid to them by the Treasury. The Treasury then issues new gold certificates to the Federal Reserve for the current market value of the gold that the Treasury holds, $1 trillion. So the Treasury then so they take in the 11 billion of gold certificates, give them 11 billion, then they give them back 1 trillion of gold certificates and receive in exchange 1 trillion of cash. Now, where does that cash come from? The Federal Reserve prints the cash electronically. So the Federal Reserve's got two sides to its balance sheet. It's got the asset side, which are the things it owns, and it's got the liability side, which are the things that it owes. So one of the liabilities of the Federal Reserve is all the cash it's ever issued. That's a liability. So when the Federal Reserve gets the gold certificates in for 1 trillion from the Treasury, it will print electronically 1 trillion of cash and give it to the Federal Reserve, to the Treasury. In other words, the balance sheet of the Federal Reserve would be bigger because they now have an extra asset worth $1 trillion, and they have an extra liability, which is worth a negative trillion. So it's just an expansion of the balance sheet. Now, this can all be done by legislation through Congress. They just have to pass the relevant law to make sure that this happens, because they've got to make sure that the Federal Reserve will play the game, if you like. But what the end result of this is the Treasury has still got the gold, and it's got $1 trillion of cash. But here's the beautiful thing. The gold certificates are not part of the national debt, and they do not bear any interest. And they're not redeemable. So the Treasury is starting with one asset, $1 trillion of gold, has now got two assets, $1 trillion of gold and $1 trillion of cash. Without increasing the national debt, it doesn't owe anything to anybody because it doesn't have to. These gold certificates, they're perpetual, non-interest bearing. They're zero coupon perpetuals. What's a zero coupon perpetual worth? Nothing. But from the Federal Reserve's point of view, they're allowed to count it as an asset.
And this is with revaluing gold to the current price of $4,000 an ounce. So what about if we use your figure of 15,000?
Yeah. So exactly. So first of all, $1 trillion isn't going to go very far when they're running up a deficit of $2 trillion a year. It's not
And
even
the
going to pay
debt's
half.
7 trillion, right? So it's kind of like a
Yeah.
drop in the ocean, isn't
So,
it?
so doing this at $4,000 an ounce will help a little bit, but it won't change the fact that the debt will be getting bigger this year and next year. On the other hand, if we do it at $15,000 an ounce, which was the figure I picked, I played with various numbers to see what might be the right number. And I came up with 15,000. That will be enough to pay off all of this year's deficit, 2 trillion, and leave 13 trillion to repay the debt which is maturing in the next 6 to 12 or 18 months, because don't forget, every bond that the government issues has a maturity date. So this debt is constantly maturing, and as it matures, they usually borrow. But what that means is they'll have cash in the bank, so as it matures, they don't have to borrow money. So as it matures, the government debt will be going down, 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 and they'll be going in the right direction from an international perspective. Now, there's huge advantages as far as the world is concerned, at least from the way they regard government debt, because it means the government debt is at that particular moment no longer spiraling out of control. We've gone down from, let's say, 37 trillion of debt. Let's say they managed to repay 13 trillion. Well, that would take it to 24 trillion, which is a situation where we were 2 or 3 years ago. That gives a lifeline, kicking the can down the road of at least 2 or 3 years or 4 years maybe, because people can say, oh, we've been there before, and nothing happened when we were at 24 trillion, whereas they're saying, oh God, at 37 trillion, something might be about to happen. It might all go haywire. But if we get back to 24 trillion, one, there's going to be less government debt out there on the planet, which means that there's going to be, from the investors who have no choice but to own it, there's going to be more competition to own that debt, meaning the prices of treasuries will be higher and the yields be lower, and that means it's going to cost the US government a lot less in interest when they roll over the debt, because the debt is, there's less of it, but there's not less people who want to own it or have to own it.
Yeah.
So it'll be very, very beneficial to the government. It'll get the interest rates down in the United States. Of course, some people will say, my God, that's going to be really inflationary. Well, not really. First of all, they did exactly this trick back in 1934. In fact, they did it the very day after they'd confiscated or rather taken the Federal Reserve's gold. They revalued gold by 67% higher in one day. They moved it from $20.67 an ounce to $35 an ounce in one day.
And this is
they
an
did
important point, isn't it? Because look, this is a historical precedent for this kind of thing. It's not kind of, it doesn't, it sounds like a bit of a crazy idea, but there is a historical precedent for this.
Exactly, and not only there's a historical precedent, but I believe they are actively considering it. We've got some extra weight to that reason. On the 1st of August this year, I think it was the Treasury. It might have been the Federal Reserve. I'm pretty sure it's the Treasury published a paper about revaluation of gold and how it is being treated in various countries around the world, because other countries in various ways have revalued gold or do from time to time revalue it from where it was to whatever the current market value is. So we haven't talked yet about revaluing it to a higher level. So what about the question of people saying, well, they're not going to do 15,000, otherwise everyone will sell their gold to the Treasury? Well, perhaps first of all, we have to assume they can't revalue it at 15,000 unless it's a plausible price. So that means we have to go back to a pre-1933 situation where you could buy and sell gold at a fixed price from the Treasury or from the Mint or from the Federal Reserve, depending on how they decide to do it. But you've got to have a plausible price. So they've got to be standing there ready and willing to buy all the gold that comes at them at the new price of $15,000. To do that, that would mean there'd be a lot of people who'd say, my God, it's 4 times the price that I had yesterday, I'm taking the money. There would be an awful lot of people who would say, well, if this is underpinned at 15,000, it can't actually go lower than 15,000. Therefore, I've got a one-way bet, because I think they're going to do this again in 3 years' time. and in 3 years' time they're going to do it at 20,000 to do exactly the same magic trick. So I'll hang on to my gold and get the better price in 3 or 4 or 5 years' time. So yes, of course, a lot of people will line up and say, here's my gold. Now, I'm going to tell you 2 more good things for the United States, because this would be really good for them. And I shouldn't be advising them how to do it, but here you are. If you're listening, Scott Bessent, I'm giving you some friendly advice. First of all, you get your hands on an awful lot of gold in exchange for nothing. Isn't that a good deal? Because as you get the gold, obviously you're going to have to pay out as you buy the gold off people. You're going to have to pay for it. But what you're getting is more gold, where you can repeat that magic trick with the Federal Reserve to get more cash. So it's the same old, same old. You keep the gold and get cash equivalent to the same value of the gold, even though you've paid out cash to third parties, but you haven't lost anything. You just end up with a situation where you've got more gold than you had, which hasn't cost you a penny. That's your first thing. So great news for the United States. You've become stronger and more powerful because you have more gold backing the currency. What does that do to the dollar? Well, might make it go up. A lot of people say it'll crash the dollar because they're going to devalue the gold. So I don't think I'm going to say it might be a devaluation in a certain sense, but it's not guaranteed that it crashes the dollar. It's not clear cut. I don't think it is. I mean, it's not clear cut. It's certain it won't crash the dollar. It will change the value of the dollar. Yes, it could go up and down, but I don't think it makes a big deal, because the more gold that the USA has, the more valuable people will think the dollar is, because it's got a bigger backing. So I don't think that's on its own. I don't think that's particularly a problem. But here's the second good thing. You are getting a bunch of you've changed the price of gold to 15,000. What does that do for all those other countries around the world who are holding treasury bonds, which they kind of secretly, slowly switching into gold now at $3,000 or $4,000 an ounce? Suddenly they've got to pay $15,000 an ounce to get that gold if they want to build up their reserves. Now, do you think it's a good thing? I'm asking your readers here, listeners, do you think it's a good thing that the USA gets more gold at the expense of all these foreign countries who'd like to cash in their treasuries for gold? Or do you think they should say to China and every other country who'd like to change treasury into gold, you go ahead and change your treasury into gold at 4,000, or no, we're going to make you pay 15,000? I think they'd rather the countries get less gold for their treasuries than they can get at the moment. So it kind of makes sense. It puts the USA into a much stronger financial position at the expense of every other country who's holding US treasuries, which will now no longer buy as much gold as they would have bought the day before the revaluation. So I think it's a good idea. I don't think it'll be inflationary. Back in 1933, when they changed the gold price, in 1934, there was no impact whatsoever on inflation. In fact, they were in a Great Depression, so prices were actually falling. But why would there be any impact on retail prices? I mean, let's face it, the gold price has gone from 2,000 to 4,000 in almost no time at all. Have retail prices doubled? No, they've ticked up by the officially 3% a year, or whatever the official inflation rate is, but not by the 30 or 40% a year that would have been needed to keep up with gold. So just pushing the gold to a new price, there's no reason why there would be any impact on retail prices at all. There might be a little bit of impact because the Treasury has now got all that extra cash, which it can now go and spend on social security and unemployment and fighting wars overseas or whatever they want to do with it. And obviously, but that's, even if they spent the whole lot, so we're talking about 15 trillion now. If we get 15,000, if we get to not 15 trillion, if we get to go from 4,000, 4,000 would be 1 trillion. So 15,000 would be nearly 4 times that. So so they're getting in 4 trillion, okay, roughly. So 4 trillion, is that going to change retail prices? Well, they're already pumping 2 trillion a year into the system due to the budget deficit. They're spending 2 trillion a year more than they collect in taxes. So all we're talking about is 4 trillion. So 2 trillion a year creating 3% inflation. Okay, perhaps 4 trillion will create a little bit more inflation, but it's not going to be that much.
I'm just thinking, Clive, is there a sense that other central banks across the world have almost been like front running this trade? Because they've been accumulating gold at quite an intensive rate, haven't they, recently? So I think gold as a proportion of global currency reserves is now it's the second largest component. I think it recently overtook the euro, and that was coming from a low base, wasn't it, in recent years? So what would you say to that?
There is no doubt that central banks continue to buy gold and they are indifferent to the price. At the end of the day, what are they doing? They're changing either their own paper assets that they can print willy-nilly for gold, or they're changing something they don't really want anymore, which is US Treasuries, into gold. So they don't really care what the price is. It's a bit like when you're buying a home. You you've got to buy one if you've got if you've got the money, but you don't care that the price of the house is double the price it was 10 years ago. You're not saying, gosh, if only I could wait for the price to go back to the price of 10 years ago, I could
Yeah,
buy it
yeah,
that price. You don't say that. You say, if I've got the money and I need it, I'm going to do it. I'm not going to wait hoping for a lower price, because you know that lower price isn't going to come. And the same thing for gold. They're not. We might well have our dips. Gold could easily dip, and I don't want to say a number, because whatever number I say, it won't be the number I say. But gold could easily dip, but at the end of the day, 10 years from now, 3 years from now, it's not going to be cheaper, because the amount of debt on the planet is continuing to increase. So as the government debt increases, the government gets poorer, and they spend that money on someone gets the money, and whoever gets that money says, what am I going to do with the money? Well, I can't buy any more pizzas, I can't buy any more eggs, I can't buy any more meat, but I can buy Bitcoin, I can buy gold, I can buy silver, I can pay for more medical expenses, which are a rare commodity. I can go to the doctor more often. So when I retire, I can buy myself a nicer home on a golf course or by the sea. When I go into an old people's home, I can go into a better quality old people's home, because all those things are in rare supply. So the extra money which comes into the system is directed towards assets which are desired but in limited supply.
yeah.
And that's why we're seeing a generalized rise at the moment in all of those types of assets, because there's a lot of money coming to the system. And unlike 50 years ago, when supply chains weren't really as working as well as they do now, so you couldn't increase the production of many goods. Now, the production of most things that we consume, which are in the consumer price index, most of the things in the consumer price index are largely built by robots, AI, factories, automation, and the supply can be fine-tuned to any increase in demand. So, if a million people extra suddenly decide they want to watch Netflix, is it going to cost Netflix any more to deliver to another million people? It'll cost them a bit more, but the expansion of the supply is very easy in the modern world. So I think when people look at the consumer price index, they're kind of looking at a historical measure, which is interesting, but it doesn't reflect the reason why it doesn't reflect what people are saving for. People are not saving up to buy more pizzas in the future. They're
Yeah.
saving up for a nice retirement. They're saving up for a rainy day when they need something in a hurry, which might be hard to get. So that the real inflation is the expansion of everything you've got in savings compared with what everyone else has got in savings, and what that's going to buy you down the line.
I'm just thinking, Clive, what this does to the status of the US dollar, if they do go ahead with this, because a lot of people are talking about the death of the US dollar, aren't they? And they point to the gold price as being a signal of that. So does this make the US dollar stronger, or does it make it weaker? Because I can kind of see both sides. You're talking about, if the US has got, the biggest gold reserves in the world, presumably that's a positive thing. But then if we see the dollar being, slashed in value, that's presumably a negative thing. So it's kind of
Well,
Which one is
well,
it?
yeah. Well, as you say, there will be positives and negatives, and there'll be people out there who see the positive side, and people out there who see the negative side, and that's what makes the market. And we see currencies; they move up and down every day, often on the back of no news at all. So yes, the dollar will move, and whether it goes up or down, it will move. But if it goes down, there'll be people who see it as more attractive. If it goes up, there'll be people who see it as less attractive. So I'm not going to say there's always this total reversion to the mean. It's not exactly like that. There will be a move, and it will be up or down. But I can't tell you whether it's up or down. But what I'm trying to say is I don't think it should be a move which is out of line with the kind of moves we've been accustomed to over the last decades. It'd just be a normal move. And of course, if it goes up, people will pin the story, the bull story. Oh, yes, they got a lot more gold. That's why it went up. And if it goes down, people will say, oh, yeah, it went down because they printed a bunch of money and there's more money in the system and therefore it's inflationary. People will pin the story to what actually happens. And you can't know in advance to what extent it's going to change the gold price. Now, if they were to do this revaluation, let's come back to some of the arguments that people have said. Some people said to me, why not a revaluation at 160,000, which would pay off the national debt in its entirety? Well, if they did that, that probably would be extremely inflationary because they've now got 160 trillion to spend compared with the 2 trillion extra a year. So that's an awful lot more money coming into the system. And probably that would be fairly negative for the dollar, I would think. But that's why I tried to come up with a number which wasn't too risky. And I thought the 15,000 is not too risky for the economy. It's not inflationary. It's not going to crash the dollar. If you do it at 5,000, it's not going to move the needle either. So you can't do it at 4,000 or 5,000. That's not moving the needle. You've got to do it at a figure which moves the needle, but not excessively so. And there's another thing about when people say why not 150,000 pay off the entirety of the national debt and start again. Well, the problem with that is that national debt has a maturity date. Each treasury bond has a different maturity date. Some of those bonds stretching out 30 years. So you can't repay a bond until it reaches maturity. So if someone signed up for a bond at 5% an interest rate for 25 years or 30 years, that's a contractual obligation on both sides. So the government can't suddenly say, oh, we're changing the rules, we're giving you your money back. So that won't happen. And as I said, I think this exercise would probably reduce interest rates on government bonds. So if someone's got a 4% bond, why would they get their money back when the best they can get by reinvesting it is 2%? Doesn't make any sense. So no, the government couldn't do it. It wouldn't be legal to do it from the government side, and investors wouldn't accept it from the investment side, not unless you were offered a really good price, which that wouldn't be there's no point in doing that. So I don't think there's any chance of the $150,000 that some gold bugs hope for. But if we get to 15,000, sure, I think that'd still be it'd be a whole situation because gold might be stuck at 15,000 for a few years, but you can be sure that as time marches on, sooner or later, that debt will have risen again and they're going to have to repeat the exercise. And the more people expect the exercise to be repeated, the more gold will trade above the revalued price. And we saw that happen obviously we had in 1970 the Nixon shock when he suspended the gold window. But a year later, or maybe 2 years later, they raised the official gold price from $35 to $42.22. Once again, booking a nice profit for the Treasury. Yeah. But in doing so, it was a reflection of the fact that the gold price was also rising, and the gold price consistently traded above the $35 price and consistently traded above the $42.22 price. So they never actually got, with their revaluations, to where the gold price was, because people said, why? I'm happy to own gold because the worst that could ever happen to me, it can't go below $42.22 because they're standing ready to take it off me at that price.
So I guess this is essentially would constitute a monetary reset, and I'm just wondering how does the crypto space feed into this? Because we've seen the Genius Act and the Clarity Act in the United States, which have kind of, they've made crypto mainstream essentially. And there's a lot of talk about the US building a Bitcoin reserve and all this kind of thing. So I just wondered from your perspective, because you have talked about Bitcoin in the past, haven't you? And you'd like Bitcoin as an asset class. So how does that feed into the whole monetary reset, if we can call it that?
Well, there's an awful lot of confusion in the world between the word Bitcoin and what is being talked about a lot by governments now, which is stable coins, or the other thing which is being talked about, which is central bank digital currencies.
Yeah.
So all three of these are digital, but two of them are almost the same as what we have today, which is the fiat money same system. So if we start with stable coins, these are coins like Tether, for example, which are backed 1-to-1 by US dollars. So you can't cash in your USDT or USD stable coins for more than $1 per share. It's $1, and the worst that can happen is you're going to get less than that. But if they have some problem, but let's assume they won't have any problems in the future because by law, they'll have to be backed by cash or by treasury bills. So the best you can ever have for your dollar of stable coins is a dollar. And what's happening to the dollar? Well, it's being, at the moment, being printed as if there is no tomorrow in the fiat world. It's being printed out of existence. It's going the same direction as every paper currency ever went in all of history, i.e. the direction which heads towards zero with eventually an infinite money supply. So if you own a stable coin, it's, from an investment point of view, it's exactly the same as owning a US dollar. Your risk is the same. Of course, you might say, but I have conveniences. I can use it in Africa, and Africans, I can move my stable coins around easily because they all take stable coins. Yes, that's definitely true, and it does also create a demand for the US dollar, because the more useful something is, the more people want to earn it. So stable coins per se now become useful all over the world because people can contract in them. They can buy and sell things in them, but it's not going to be any kind of long-term store of value. It's going to be a store of devalue as the value of the dollar goes down. As the dollar halves, your stable coin's worth half as much. Not half
But I
as
guess
many
if you're
dollars.
kind of like a currency in somewhere like Africa where it's inflating at some kind of stratospheric rate every year, it's probably preferable, isn't it, to hold in the domestic currency? So I
Yeah,
guess that's where the utility comes in, isn't it?
yeah, exactly. If you're in Argentina, for example, where the rate of inflation is north of 40%, or Turkey, where it's 40 something, but then stablecoin, and of course lots of African countries too, stablecoins seem like a wonderful thing as an alternative to your local currency, because provided everybody's willing to transact in them, and I guess they are, it's a way of not losing money while you're sitting on your money for a week or a month or a year. But of course, that's the situation today. But as if things are left unchecked, the government debt will speed up, getting bigger and faster and faster, and we will get to a point where the value of the dollar would be falling rapidly if something is not done. And that's why I'm saying they have to do something. And by the way, the gold revaluation is not the only thing. I'll touch on some other things in a minute. But they have to do something to rein in the government debt. Otherwise, it will just spiral. It is in the process of spiraling out of control. So, but if they don't do anything, we get this situation where the dollar starts to become like an Argentinian peso. It's going down every day, and you're saying, well, it's okay to hang on to it for a day or maybe in a week, but I don't want to hang on to it for a month, because in a month's time it's going to be worth 3 or 5% less. So that's stable coins for you, and the central bank digital currencies are another form of stable coin. At the end of the day, there is a subtle difference. The central bank digital currency is the currency issued by the central bank. In the UK, that would be the Bank of England. In America, it would be the Federal Reserve. In Europe, it would be the ECB, the European Central Bank, and so on. So the central bank digital currency is a direct liability of your central bank, whereas a stable coin is a liability of an independent organization, a company, which by law is obliged to own treasury bills or bank deposits. So there's effectively 2 or 3 layers of risk here with the stable coins. You've got the risk about the company which has issued them. Are they reliable, honest, and still in business for whatever reason, and don't get hacked and all kinds of things like that? And then the second layer is what they're investing in, bank deposits and treasury bills, safe? Well, then the question is, are the banks safe, and is the government able to repay? One assumes in both cases yes, but it's not as safe as the central bank digital currency, but they're both effectively dollars, 1 for 1 to the dollar initially. On the other hand, Bitcoin is something else. It's not a currency. It's something which is now being, little by little, accepted by treasuries. That includes government treasuries as well as corporate treasuries. Very, very few at the moment, but little by little, as something they will hold in their reserves as a diversification away from the dollar, so they don't have all the eggs in the dollar basket. And they probably have euro. It's not the only thing they have. They probably have euros, and they probably have Japanese yen, and they probably have dollars, and they have Bitcoin. And so we're starting to see a growing number of treasuries say, it's been around for 17 years, it's had its ups and downs, it's still here, it's immutable, and there will never be more than 21 million. All we have to believe is that it will still be here next year or the year after or 10 years from now, and we have to believe that someone will take it off us. Well, the number of institutions, big holders who believe that, is not getting any less. I mean, the number of doubters and skeptics far outweigh the number who believe it, but the number who believe it is not reducing. That's a fact. Okay, and from another point of view, there are people all around the world who worry that what they own may be unjustly taken off them. They can steal your gold, they can shut your bank accounts, but your Bitcoin is just 12, could be, if you do it right, just 12 words in your head. And if you can remember them, you can cross from one border to the next border without being stripped of your, well, you might be stripped of your gold, but they can't strip you of your Bitcoin unless you have what's called the sledgehammer attack, where they force you to disclose your 12 words which are in your head. Yeah. But you can, I mean, we mustn't forget that it's been very well known that for years Chinese people have been arriving in Europe, having bought Bitcoin in China and recashing it in Europe to buy houses in Portugal or wherever, because, and I'm not saying that's legal, because obviously exchange controls prevent them from taking out more than a certain amount from China, but you're crossing the border with your suitcase and something in your head. But it's not just people who are fleeing from place A to place B. You've got people who might find their enemies take what they have. Could be a village chief somewhere in Africa. He's got his wives, he's got his gold, he's got his cattle. But when the neighbouring village invades his village, they'll take all of that. But if he's wised up and found a way to get some Bitcoin, they can't take that. You might have a battered housewife who's controlled in her finances by her husband. And so she's, in the traditional world, it's very hard to build up a stash of cash with which to run. Because her day, she wants to run, but you can't run if you're financially impoverished, if you've got no money, you've got nothing to run with. But if she can, from time to time, take some of the housekeeping money down to the post office or the railway station and stick her phone under the machine and get a little bit of Bitcoin here and there, it won't take too long before she's got a few thousands, which will be enough to get her started the day she runs from her husband, as opposed to running and having nowhere to go. You can take the person who, through misfortune, has been seen shaking the hand of some wicked dictator, and now he's perceived to be a friend of the dictator and therefore now a sanctioned person, and the banks close down all his bank accounts. Well, they don't close your bank accounts in every single country. It depends only the countries which follow the sanctions rules. So you at least have the option of moving to a place where those sanctions don't apply and cashing in your Bitcoin and starting again, and so on and so on and so on. So there's an army of situations where people can say, I don't actually care what the price of Bitcoin. I'm not buying Bitcoin to make money. This, that everyone says, oh, you're buying Bitcoin to make money, and and you're hoping it'll go higher, but it's all a Ponzi. It's not going to go higher. These type of situations, people don't care whether the price is higher or lower. They just want to own something, just like they want to own gold. They want to own gold for exactly the same reason. It will get them to the other side of whatever situation might crop up in the future. They don't know what's going to happen, so they want something which will still be there. And obviously, gold is one of the things that will still be there, and it will deal with many, many situations which might happen on the planet relating to the finances. But it perhaps isn't so useful if you're in 1939 and trying to flee from Germany to get to a safe haven country, and you've got the Nazi border guards stripping everybody of their gold if they, as a bribe to get out. Well, I think they would have found Bitcoin rather useful in 1939 had it been around. So there are real situations where people can see a value. Now, most of us live in nice, safe Western countries where we can't see the point. Well, perhaps maybe there's a few men who are getting divorced or women who are getting divorced who think, well, a little bit of Bitcoin on the side will give me that edge over my wicked partner, perhaps. But, broadly speaking, most people won't see an advantage. So they say, I can't see any use, therefore it's worth nothing. But there are people out there who do see a use. And of course, we have the backing of financial institutions who are creating Bitcoin vehicles into which you can invest, which own Bitcoin, like exchange traded funds. And there's going to be more of those coming around the world. And they're passing laws in different countries where you'll be able to own, for example, in pension plans and things like that, you'll be able to own Bitcoin holdings or ETFs holding Bitcoin in your pension fund as part of your investment portfolio. So the direction of travel is favourable. Sorry, say that again.
The US government is also a big fan of Bitcoin now, because they've stated they want to own Bitcoin, but I think the wording was that they want to do that in a budget neutral way.
Yeah, well, that was where the Bitcoin Act came in, because they could have done exactly what I described to create money out of thin air, to buy the Bitcoin.
So how, I'm just thinking, how does that sit alongside the kind of the gold reserves? What's the relationship between them, and what's the significance?
Well, the more assets a country has, the better its currency is going to seem. So obviously there are things which back your currency, like having a big army or a stable currency. But if you've got something to back your currency, potentially it's seen as not, right, it can be seen as not potentially worthless. Now, obviously, we know that in reality, there's no currency on the planet which is backed by anything today, because nobody's really promising to give you anything for your fiat cash except another bit of paper. So it's not really backed by anything. But there's still this concept that if you've got a rich country, somehow things will be all right. And if you've got this Bitcoin reserve, well, it's there, and in a time of emergency, perhaps it can be used in some way. But I don't really see it as a big deal in itself. I just see it as another indicator that there are big institutions saying, what about diversifying and having a little bit of Bitcoin. So when the Bitcoin reserve is created, and I think the way they're creating it at the moment is just to say, instead of selling the Bitcoin which we have confiscated from criminals, we'll hang on to it. That's, I think, the direction of travel at the moment. So it's actually, the way I see it at the moment, it's pretty, as far as the United States is concerned, I see it as pretty neutral. I don't see them going into the market and buying up billions of dollars of Bitcoin with newly completed cash. Of course they could, but I don't see that's not appearing to me as a plan. It's more the fact that they will be putting it as part of their reserves, and then we might have another country who says, well, if the United States has got that, why wouldn't we? And there will be more and more countries.
Another component of reserves, essentially.
Yeah, it's the and again, this is why more and more companies are starting to create Bitcoin treasuries, because they're saying, we, and this may seem very selfish, but a lot of them have got executive shares. They're the shares owned by the board of directors, by their senior managers, and everybody wants their share price as high as possible. So there's two things in the modern world which push your share price higher. One is to say you've got Bitcoin, and two is to say you've got AI. What's happening with Tesla? They own Bitcoin and they got AI. So this is the mantra of the world. Let's put some Bitcoin in our treasury, get the share price up, then we can sell our share options and make a lot more money as executives.
It does seem to be the modus operandi at the moment. So what signs or triggers should investors be looking out for if they're looking to kind of see the direction of travel in terms of this potential revaluation? Are there some kind of telltale signs that we might see beforehand, or will it just kind of be sprung upon us?
Well, if you're hoping that they'll give you a month's notice before they do it, it's not going to happen. But there will be people in the know, and the plans, I believe, have already been made. Plans not in terms of we're going to do it on this particular date. It's plans if this particular situation occurs, which would be typically a debt crisis. This is one of the ways we can solve it, and it's a very attractive way. So it will be one of the options we're looking at. So the plan is sitting there ready to be implemented. So every company on the planet, as do governments, as do central banks, they all have contingency plans for all kinds of things. No matter where you work, in a big company, they'll have an entire department designed for risk management, working out contingency. So this will be there as one of their contingency plans, and there'll be people who are in the know, who also know that when the probability of it happening is increasing, and their friends will know, and their friends will tell their friends at the barbecue. So there'll be an army of people who, in some way, shape, or form, are tipped off. But it's not going to be you, and it's not going to be me. So all we have to rely on is what the market is telling us. And the way the market will be telling us that it's getting closer is when the price starts to rise for irrational reasons, irrationally. Now, to some extent, I've got this feeling that it's starting to happen already, because we're seeing the gold price go up faster and faster without a corresponding rise in inflation. Of course, there are some expectations that we'll have a lot of monetary easing down the line in a year and a half or a year's time. But really, there's no war at the moment, and hopefully won't be. There's no rapid rise in inflation at the moment. We're going into recession. The economy's slowing. I don't see that any of those factors would be bullish for gold, yet gold is going up faster and faster. So this could be an early warning sign. Now, we're not at the acceleration phase, but if we get to the point where it's jumping up $100 a day, I would say that's perhaps your warning sign that it's just around the corner.
So, Clive, thanks so much for coming on the show today. And I just want to mention to everybody your YouTube channel, which just seems to be going from strength to strength. So how do people follow you? Is it just by Clive Thompson, yeah?
Yeah, so you can, first of all, you can go on LinkedIn and find Clive Thompson, Switzerland, or you can go on YouTube and find Clive Thompson. I'm doing a lot of videos all about making money, all about investing in the stock market and similar things.
Clive, it's great to have you on the show again. I just want to wish you the best of luck with all your YouTube endeavours, and hopefully we'll have you on again sometime. Thanks again to Clive for his time today. We'll be back soon with Simon Popple for the last in this 3-part series on gold. Don't forget to give us a like and a follow if you enjoyed the pod, and thanks for listening.